Hey, good morning, everybody. Welcome back to the Opportunistic Trader. We're joined by Tony Greer of TG Macro. Tony's been giving us some great information on some trends in the markets. How's it going, Tony?
Great, Mike. How you doing today?
I'm good. I'm good. We've got it's been a really active week today. A lot of central bank action, and we also had a lower than expected CPI. Tell us what you're looking at right now. What's been moving? What catches your eye?
Well, it's all been an emerging markets trade, right? This morning, Turkey's central bank sort of won out over Erdogan and threw a rate hike on the tape, and that is rescuing the currency pretty dramatically. You've got the Turkish lira well off of its lows. You've got the ruble and rand now well off of their lows. And you've got a major reversal in the Indian rupee this morning, which is worth noting that this is probably going to take the pressure off emerging markets, maybe for the balance of the week and maybe as long as another week or something like that. Because we've got some extreme patterns on the charts. Like if you look at the Indian rupee today, it opened up at a new low of 72 or so, nearly 73, and then reversed all the way back to almost 72. So that sort of looks like that currency is turning as well. Naturally, we're going to see a bounce in EEM alongside that. We're going to see a bounce in the European banks alongside of that. But what matters to me is where they end up. And when I look at the European banks, it's still a dead cat bounce. When I look at EEM, it's still a dead cat bounce so far. But I feel like it would be a great opportunity to get to sell these, or especially emerging markets ETF, up in its moving averages again, because I still believe that the dollar strength is going to persist.
Yeah, so what do you think the catalyst is? Obviously Turkey raised interest rates dramatically up to 24%, 6%, but things seemed to turn yesterday. Things were looking pretty ugly. We got a lot of tech downgrades. Stocks were trading under pressure, and then there was news of this China deal. Is that really what's kind of moving everything here, continuing for the 24-hour period here?
I mean, the media wants to blame everything on the trade wars, up or down. If you ask me, it's like, emerging markets weakness was on the cover of Field and Stream. And that's usually a sign that it's a near-term bottom. You know what I mean? The ETF is backed off from 52 to 42. The media is finally picking up. They're all over it. So you're going to get these last set of weak shorts in that have to cover. And then you actually had, the central banks doing something sensible in Turkey. So that's a big help. You know what I mean? Like, I'm not going to deny it. I've been an a steadfast emerging market bear since May. And I'm still a bear, but this thing is going to trade. Just like everything else, it's going to have fits and starts and make new lows and then trade up into the moving averages. But I'm confident the trend has turned there. I'm also confident the trend has turned in social media stocks. I am delighted to see the social media ETF SOCL up 2% today. I would love to see it up 5% so that I could start whacking away at it, because I firmly believe the worm has turned for social media.
Yeah, you were mentioning us that time. Are there a few names that you don't like in social media that you tend to
Yeah,
think
I'm
are?
I'm bearish as hell Facebook. I'm bearish as hell Twitter. I respect Facebook. One thing that I saw that I was digging in about Facebook that's really interesting, because I'm still saying to myself, wow, I feel like this stock should be lower. And I checked out the holders page for Facebook, and I learned that in the last holding period that we had a couple of big mutual funds add to their long position, right? So we had T. Rowe Price tack on 9 million shares to their long. They're now long 85 million shares. The Capital Group, right, which are America's funds, they added just the casual 30 million shares of Facebook length on this last dip. And that's great for me to see. I know that the stock is changing hands, but it's going down. I understand that it's not lower because we had a buyer of 40 million shares that were for sale between Capital Group and T. Rowe. And I would imagine that they're going to stay around and keep buying it because that's what plain vanillas do. They're going to buy this thing all the way down, to the 150s and into the 140s and hope that they're right over the 10-year horizon. I got a feeling that they're going to be left holding the bag with the stock, but I've been wrong before in Facebook. I just think that this time it's different.
Yeah, that's pretty interesting. Also, looking at those holders, things like that, it just goes to show you how those guys acquire, how they scale into positions, and the cycle of things. So yeah, you've been mentioning SOCL. We keep an eye on that, and like you said, a few of these things, EEM, SOCL, having a bounce that definitely people, if they're bearish, can definitely take a look at.
The bounce is not going to last long, though. You got to short this thing on the bounce. I mean, Twitter is the biggest component, excuse me, of SOCL at about 11.5%. And if you look at it, the chart matches the narrative to me, right? We had the steep pullback at the end of July when we learned that they were losing average monthly users. It landed on the 200-day moving average to see what was going to happen. Then Jack Dorsey went in front of the Senate and blew his brains out, right? Like an utter fool. He said they have to do a better job at transparency. He said that their verification system needed a total reboot. And then he went ahead and blamed, shadow banning conservatives on a computer glitch. And I think the market is voting on that right now, saying, oh, really, Jack? Sounds like bullshit to me. And that's why the stock is at $30 now. So I'm looking for sort of very shallow peaks in social media to sell into, because I don't think that Twitter is going to rebound all that much. And I feel the same about Facebook. So any kind of bounce in SOCL, I'm trying to sell.
Yeah. And I know you don't have that much time today, but I definitely wanted to point out and get your thoughts on the 10-year. We're right now just below 3%. And, we had lower CPI, which initially knee-jerk dollar sold off. Yields went lower. But, the interesting thing is yields are actually a touch higher now on the day. What are your thoughts on that and what that could mean for the market?
Yeah, I'm still a Treasury bear, so I'm still bullish on yields. I still believe in the stronger dollar story based on, our 4.2% GDP, our 2.9% CPI, our 3.9% unemployment. Obviously, the CPI data is going to fluctuate. We have never had runaway inflation in a long time, here in this country. So I don't expect to see runaway inflation now, which means that I don't expect rates to go flying away. But I'm still positive U.S. rates. I think that if you're sitting here waiting for the U.S. economy to just stop and take a dump, I feel like you're looking in the wrong place, because the data has been consistently strong.
So if we break through 3% here in the 10-year, which I think it's trading pretty well based on all these things, what do you think the reaction is? What are you looking for opportunities in if yields start to pick up?
It's very clear that the stock market can deal with higher rates, right? Here we are at S&P 2900 with the US 10-year just below 3%. So I'm not going to say that, higher yields are going to be bad for the stock market at all. I have no problem with that, because we're getting the backside from the strength in the economy. So we're going to need higher yields. And it seems like Jerome Powell has been pretty hell-bent on raising them very carefully and methodically, despite what the data is. When we were staring at, kind of really, really lousy data. Let me get up the chart here. We've been looking at really lousy data over the summer, et cetera, and the bond market has still been on the lows with yields on the highs. So I don't really think anything has changed. So, I still think it's a matter of being in the right sectors. I don't think it's a totally interest rate sensitive equity market anymore at all. I think that as rates started to normalize, we were cautious about that, but we've proven 8 ways through Sunday that higher yields definitely don't necessarily mean a lower stock market.
Yeah, and right now here we are, 2 years at 276, the 10 years at 297. And the one thing that I find interesting about the price action today is what Mark Fisher talks about. He talks about sometimes good news, bad price action, bad news, good price action. And I think the 10-year, the future, and the future itself, initially the fact that on CPI it's not continuing higher, that's a sort of bad news, sort of the price action, probably would expect on CPI for the 10-year to be higher the future, but that's as of right now not happening. So we'll definitely keep a close eye on that. What about social media and
energy is interesting, right? Energy is kind of interesting heading into this Florence weekend. Right, crude oil's bid, truckers are bid. There's clearly going to be a significant impact from Florence. Exactly what, we don't know, but it's always good to have these volatile episodes heading in. I mean, not in terms of good for the hurricane, but good for the markets to have these volatile episodes, so we can sort of see where it shakes out in the aftermath. And I have to say that I'm getting a little bit disappointed in crude oil. I would have thought it would have been a little bit higher, number one, with Florence, and number two, with how strong the Brent has been trading over TI. I thought that would have pulled the complex up a little bit higher, well into the 70s. Since we are not seeing that, I'm getting a little bit concerned. I want to really make sure that I'm out of my crude oil length and my super bullish posture if we start registering a few closes below the 200-day moving average, which is at 65.5 now in WTI.
Yeah, I just pulled up the chart on that, and it's really textbook right now, where it made nearly a double top, and this is kind of the upper end of the range for the past like 3, 4, 5 months here. We've really been between 71.50 and the low 60s, and yesterday on all that news and I guess hurricane fear, we moved higher, but here we are 69.50, so it'll be really interesting. Like you said, it's especially with the storm coming up on Friday. We'll probably have a lot more news after the weekend, so that'll be really interesting to keep an eye on.
Yeah, nonetheless, though, WTI crude oil is still in the dead center of its up channel. It's hanging on to moving averages. So I just sort of, it's just the kind of thing where I wanted to temper my bullishness, based on, the price action response to what's going on. I kind of feel like crude oil should have been shooting up to the mid 70s. Since it's not, let's be a little bit cautious here. But above $60, it's still in its uptrend. It's still okay.
Gotcha. All right. Well, Tony, thanks a lot for joining us. I know you got a lot of things going on today. I really appreciate taking the time. We'll definitely speak to you soon to get some more thoughts.
Cool, Mike. Thanks for having me on. I appreciate it.
All right.
Buddy.
Talk to you later, Tony.
See you, pal.